So by this point in our series, we are past the pre-audit phase. So we've done the risk assessment, assessed materiality. Now we're in the main phase of the audit. So we're going to test the different areas of the company. So to imagine the structure that we're going to approach, if you could picture a basic balance sheet, cash, AR, inventory, investments, property, and on the liability side, accounts payable, your debt, like your notes payable, and then your equity. So we're going to go through each of these sections and talk about how you would actually test them in an audit. So before we jump into auditing cash, let's talk about something that's called directional risk. What this says is that a company tends to overstate its assets and understate its liabilities. We need to think about what makes a company look best. Well, when a company has a high amount of assets and a low amount of liabilities. So to make the company look as good as it can, it's going to tend to overstate the assets and its equity and understate its liabilities. So when we're talking about cash, we're thinking, is the company going to overstate its cash balance? That's one of our main concerns. Our other concern for cash is, are employees going to try to steal cash? So there's a high fraud risk for cash. So in terms of fraud for cash, there are two opportunities of how the employees could steal cash from the company. The first is going to be called lapping. So we could think of running laps around a track. So what's going to happen here is you have a customer that's going to pay for their AR balance of what they owe the company. So you have customer one paying their AR balance. So they send money into the company and the employee is going to steal that money, but they're going to cover it up. When the second customer is going to pay for their balance, then that employee is going to take the second customer's payment and apply it to the first customer's balance. And then when customer 3 pays their balance, they're going to apply it to customer 2. So they're essentially doing the same process over and over again, which is why it's called lapping. And then the second chance for fraud within cash is called 𝗆ing. Now this is not stealing cash, this is fraudulent financial reporting. This is when the company has multiple bank accounts. They're going to do a transfer from one account to the other, but they're not going to write off the transfer in the one account. So the cash is going to remain on their books in the first account, but they're transferring money to the other account, which increases cash. So their cash is essentially being double counted. So that is called 𝗆ing. So one of the main ways that we audit cash is by sending cash confirmations. So a confirmation is something that the auditors are going to send to the company's bank, and the bank's going to respond directly to the auditors. That way, the client cannot interfere with the actual documentation. So we're going to send this confirmation to the bank, and we're going to say, the company says that they have $100,000 in their cash at the end of the year. Can you please confirm that they actually have $100,000 of cash? So then the bank's going to respond back and say, yes, we see that same amount in our records, or no, we see a different amount in our records. So that's the purpose of a cash confirmation. So the next way that we audit cash is by reperforming the company's bank reconciliations. So what is a bank reconciliation? Well, there are certain items that the company's bank account knows about, but the books do not know about, and certain items the books know about, but the bank does not know about. So a bank reconciliation is going to reconcile those different amounts. So for example, consider an outstanding check. This is when a company sends out a check for a payment, but then it hasn't been cashed yet. So for the books, it needs to go ahead and decrease the cash balance, but it hasn't cleared the bank yet, so it's not going to decrease the bank balance. So the bank reconciliation is looking at checks outstanding, deposits in transit, etc. So as the auditors, we need to look through these different items on the bank reconciliation, make sure that they are legitimate, make sure that the beginning balance agrees with the company's bank statement, and make sure that the ending balance agrees to what the company actually has recorded on their books for the cash balance. So in this video, I'm just briefly talking about the confirmations and the bank reconciliations. In my comprehensive audit review course, I actually show you what they look like. So if you're interested in free preview, you can check it out below. So now let's talk about auditing the areas of accounts receivable and revenue. We audit both of these areas together because if we think about the journal entries for both of them, when we make a sale, we have debit to accounts receivable and credit to revenue. So for testing AR and revenue, we have 3 main procedures. We have AR confirmations, we have subsequent collections testing, and we scan the AR aging report. So first, let's talk about AR confirmations. So in the cash section, we said that we can send confirmations to a company's bank to confirm the bank balance. For an AR confirmation, we're going to send a confirmation to the customers that owe us money to confirm that they actually owe that amount of money to the company. So that helps us to test the existence assertion for AR. In terms of subsequent collections testing, this is for the AR balances that we haven't received an AR confirmation for. So if we think about it, at year end, we have an AR balance, and then we're auditing the company after year end. So during the period that we're auditing them, the company is going to have received some of their customer payments. So we're going to look at the customer payments they've already received to say that since they actually received the payment, then this year-end accounts receivable balance is legitimate. And then we scan the AR aging. So the AR aging is going to say which customers owe you money and how long overdue their balances are. So we're going to scan it for any long outstanding items because maybe the company should write that off as uncollectible. So this is the main way that we test AR and revenue. Now let's talk about how we audit the company's inventory balances. So inventory is for items the company has bought to then sell, or they have actually manufactured to then sell. So they are assets on the balance sheet, and we want to make sure that they are actually legitimate. So what could go wrong with inventory? Well, the company could include inventory on its balance sheet that doesn't actually exist. It could accidentally miscount its inventory balance so the valuation is not correct. It could also have slow-moving or obsolete inventory that actually needs to write off of the balance sheet. So the main way that we test inventory is through what's called an inventory observation. So the highest quality audit evidence is when the auditor actually goes and views something with their own eyes. That's the highest quality evidence, direct audit observation. So when we have an inventory observation, the auditor is going to go to the company's warehouse where they store their inventory, and the employees of the company are going to be performing a count of the inventory. So the auditors are going to watch the employees while they perform this inventory count to see how much they can actually trust in this count. So how good the processes are that the company has for counting inventory. So then if we can trust in the company's processes for counting inventory, we can trust in the company's year-end balance for inventory. So inventory observation is the main way that we test inventory. So now let's talk about auditing the area of investments. So investments are when a company invests in another company's stock or in another company's bonds. So the most common procedures are for recalculations and confirmations. We're most concerned with investments about the valuation of the investments. Are they valued properly? So if we recalculate, for example, with bonds, let's say the company has a $1,000 bond and they have a 5% interest that they receive on it. So we're expecting that they receive $50 every year of interest income. So we just perform that recalculation. Or if they have a $100 stock and it receives a 10% stock dividend, we expect them to record $10 of dividend income. That'd be the recalculation. We could also send confirmations for the company's stocks. So if the company itself doesn't hold the stocks, but a third-party custodian does, we could send a confirmation to the custodian to confirm that the company actually owns those stocks. We also need to think about the segregation of duties for investments. So we have the authorization function, which is for buying and selling the stocks. This would be by a high-level part of the company, like the board of directors. Then we have the recording function, which would be for the accountant that's just making the journal entries for the investments. And then we'd have the custody function, which would be like the third-party custodian that actually holds the ownership of the investments. So this is how we audit the area of investments. So now let's talk about auditing a company's property. So these are the fixed assets of the company. So fixed assets make up a relatively large portion of a company's assets because they're large investments and they take a long time to depreciate. So for assets, we have a lot of different accounting transactions. We have the initial purchase of the assets, debit to fixed asset, credit to cash. We have the depreciation of the assets, debit to depreciation expense, credit to accumulated depreciation. And we have the sale of the fixed assets, where we record the gain or the loss on the disposal. So as the auditors, we're trying to make sure that the company is recording all of these transactions correctly. So we create what's called a fixed asset roll forward schedule, where we're going to start with the beginning balance of the fixed assets. We're going to add the additions for the year to fixed assets. We're going to subtract out the deletions, the disposals of the fixed assets, which brings us to the ending balance. So we're trying to make sure that the ending balance that we calculate as the auditors is going to agree to the company's ending balance on their GL balance. We're also going to do a roll forward schedule for the company's accumulated depreciation to make sure that they actually calculate their depreciation correctly. And then we're going to perform recalculations for different elements. So for example, whenever the company has a gain or a loss, we're going to recalculate the gain or the loss because we know that the sales proceeds minus the net book value should be the gain or the loss. So we're going to compare our recalculation to the company's actual recorded gain or loss. We're also concerned with whether the company should record an expense as a fixed asset. Should they capitalize it, or should they record it as a repairs and maintenance expense? So we have to compare whether they're recording that correctly. So these are the main areas of concern when we're talking about fixed asset testing. So in my comprehensive audit review course, when I talk about auditing fixed assets, I show you what the actual roll forward schedule looks like so you can really visualize how it works. So now we've talked about auditing all of the major asset accounts of the company's balance sheet. Now let's move to the liability section of the balance sheet. So we said that for the assets, our concern is that the company will overstate the assets to make the company look better. Now that we're talking about liabilities, the companies tend to understate their liability balances because the less liabilities they have, the better the company looks. So here for liabilities, the completeness assertion is really important. We want to make sure the company is not excluding any liabilities from its balance sheet. So now let's talk about auditing a company's accounts payable balance. So we have two main procedures here. We have a search for unrecorded liabilities, and we scan the company's AP aging. So let's talk about search for unrecorded liabilities. So what we're going to do, we're going to ask for the company's check register between the year end and the date that we are auditing the company. So it's going to show us all of the cash disbursements that the company had. So we're going to select different disbursements based on our materiality levels. Then for each disbursement, we're going to see if it applies to the prior year or if it applies to the current year. So if it applies to the prior year, we're expecting that the company should have an AP balance from that disbursement. And if it applies to the current year, then we're going to see that it shouldn't be included in the AP balance of the prior year. So it's used to look at the cash disbursements to see if it should be an AP item in the prior year or in the current year. And then from there, we can scan the company's AP aging. So what we do here is just like the AR aging shows all of the customers that owe us money, the AP aging shows all of the vendors that we owe money to. So if there are any old outstanding AP items, we need to ask the company, are you going to actually pay these items, or do these not apply anymore and we should write these off of your AP balance? So that's how we audit the AP area. So now let's talk about auditing a company's notes payable balance. So notes payable are long-term debt. So the company borrows money from the bank and they're going to record a liability on their balance sheet. But they have to record a long-term portion and a current portion. So the current portion is the principal that they have to pay off over the next year. So as the auditors, we need to make sure that they're properly recording the long-term portion and the current portion. So that's the classification assertion. We also need to make sure that when the company makes a payment, they realize that part of the payment goes towards interest expense and part of it goes towards the principal. So we need to make sure they're properly recording their journal entries. So for debt, we create a roll forward schedule. Just like for fixed assets, we're going to start out with the beginning notes payable, add in the new notes payable, take out the principal that we pay off, and that should equal our ending balance. So for the area of notes payable, we have two important documents that you need to know about. First is the debt agreement. So this is when the company initially takes out the loan with the bank, what the agreement is for the loan. So how much did the company borrow? What is the interest that they're going to pay on it? And how long do they have to pay off the loan? So with this, we can create the amortization schedule. The amortization schedule is going to show throughout the life of the loan how much of each payment is going to be for principal and how much is going to be for interest expense. This is going to help us with recalculating the note payable roll forward schedule and for recalculating the interest expense. So in my course, I go further in depth on these documents and show you examples of each one of them. So now that we've talked about auditing accounts payable and notes payable, we're ready to move on to the equity section of the balance sheet. So just like with the asset accounts, a company tends to overstate its equity because the higher the company's equity, the better the company is going to look. So what accounts are in the equity section? We have retained earnings, which is all of our income that we've accumulated throughout the years minus our dividends. And we have our stock, like common stock and additional paid in capital. So the auditors can perform a recalculation of retained earnings. So we start out with the beginning retained earnings plus net income for the year minus dividends that we pay out that year, and that should equal our ending retained earnings balance. In terms of the stock portion of equity, we could scan the board meeting minutes to see if the company is going to issue any additional stock, to see if they're going to buy back any of their stock as treasury stock, and to see if they're going to declare any dividends. So these are the main procedures for the area of equity. So now that we've talked through the entire balance sheet and how we audit each area, let's talk about sampling within auditing. Let's talk about what sampling actually is. So due to having limited resources, we as the auditors can't test 100% of the company's transactions and balances. That would take way too much time and cost way too much money. So what we're going to do is we're going to select a sample of the balances and then make assumptions about the entire population based on the sample. So imagine that in the company's accounts payable balance, they have 100 invoices. So instead of testing 100 invoices, maybe we test 15 invoices. That's our sample. And then we make assumptions about all 100 invoices based on the sample of 15 invoices. That's the main idea about sampling. So for sampling, we have two major approaches to sampling based on what we're trying to test. First, we have what is called variable sampling. This is where we're going to use sampling for looking at dollar amounts. So we're trying to identify material misstatements. So since we're looking at dollar amounts, then we are talking about a test of details. The other kind is called attribute sampling, which is looking at a test of control. So instead of looking at dollar amounts, it's looking at a rate of occurrence. So how often does the company follow the control that they're supposed to follow? So it's looking at a certain percentage instead of a dollar amount. So that is attribute sampling. Then we have how do we select the sample? We can either use a calculation to select the sample, which is called statistical sampling. This is to where each item has an equal chance of being selected in the sample. Or we can use non-statistical sampling, which is where we don't use calculations to find the sample. Instead, we just use our judgment as the auditor to make the selection. So within attribute sampling, which is for test of controls, we have a few key terms. So since it's a test of controls, we're trying to look at the operating effectiveness of the internal controls. We're trying to figure out, can we rely on the controls and therefore decrease our control risk, which allows us to increase our detection risk and therefore decrease the amount of substantive procedures that we perform. So the first term is called sample deviation rate. This is what percentage of the items in our sample do not follow the control. So if let's say we're testing 100 invoices and 5 of them don't follow that certain control, then our sample deviation rate is simply 5%. So then is the sampling risk. So sampling risk means that since we're only testing a sample and not the entire population, the assumptions that we apply to the entire population may not be correct. So the sample may make the population look like it's great, but then if we tested all the other items, we'd see that it is not so great, or vice versa. So for these terms, we're going to have what's called allowance for sampling risk. So we're going to add in a few more percentage points just for the sake of maybe we don't make the right assumptions about the sample. So we're going to take the sample deviation rate plus our allowance for sampling risk, and that's going to equal what's called our upper deviation rate. So we're going to compare our upper deviation rate to our tolerable rate, and if our upper deviation rate is above our tolerable rate, then we can't rely on the controls. And if it's below our tolerable rate, then we are allowed to rely on the controls and therefore decrease our control risk. So then the last area to talk about for this main section of the audit is the legal inquiry letter. So as the auditors, we want to make sure that if the company is in any lawsuits, that they're properly including the information in their financial statements. So we're going to send this type of confirmation to the company's lawyers, which is called the legal inquiry letter. So we're going to send this letter to the lawyers, and we're going to ask them to tell us about any lawsuits the company is currently in, what the chance is that the company is going to lose the lawsuit, and an estimate of how much they could lose if they do lose the lawsuit. The reason it matters is because we either have to disclose the item or accrue and disclose it. So there are going to be 3 possibilities here. We're either going to have a probable chance that the company loses the lawsuit, which is the highest chance. They would have to disclose it in their financial statements in a footnote and accrue for the loss. So from the estimate, they're going to actually have a liability for this lawsuit. The next level is reasonably possible. For this, we don't have to accrue anything, but we just have to disclose it in the footnotes. And then the third level would be a remote possibility. If it's a remote possibility that they lose the lawsuit, we don't have to disclose it and we don't have to accrue it. So that's the purpose of the legal inquiry letter. And in my comprehensive audit review course, I show you an example of what the legal inquiry letter actually looks like.